You know, usually when we sit down to do a deep dive into the financial markets, the conversation inevitably turns to bracing for impact.
Right, yeah, like how to survive a crash.
Exactly. We talk
Mhm.
about weathering the storm or, how to protect your downside when everything on the screen is just painted red.
Well, I mean, it is the classic defensive posture.
Yeah.
Human nature just naturally prepares us for danger, you know? We are hardwired to look out for threats in the brush.
Yeah, but what happens when the market absolutely refuses to panic? In fact, what happens when it does the exact opposite and just completely surges?
Because if you look around right now, that is exactly what you are seeing.
Right. I mean, semiconductor companies, Intel, Micron, AMD, they are realizing massive double-digit percentage
Oh,
jumps.
totally. The S&P 500 and the NASDAQ are out there hitting new all-time highs on a regular basis.
It is not fear out there right now. It is just absolute euphoria.
And euphoria requires an entirely different playbook. Surviving a market crash is one thing. Figuring out how to survive and actually thrive in a market frenzy, well, that's a completely different psychological and mathematical challenge.
So that is our mission for this deep dive. We are not talking about pessimism and disaster today. We are unpacking the exact opposite.
Yeah, we are going to examine 4 legendary trades from financial history to extract the ultimate playbook for navigating market manias.
And because navigating these manias requires serious data, we want to remind you that to access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store.
Yeah, having a tool like the Buffett indicator is exactly what keeps you grounded when, well, as we are about to see in our first case, the whole world just loses its mind.
Right, it is crucial because when a market is booming and valuations seem to make absolutely no sense, the hardest thing to figure out is when the balloon is actually going to pop.
Exactly. Do you fight the momentum or do you ride it?
To answer that, I think we have to travel back to the year 2000 to a man named John Templeton.
Oh, Sir John Templeton.
Mm.
A true legend. I mean, he had lived through 2 world wars, 3 global panics, and like a half dozen massive market bubbles.
Yeah, his entire career was built on the philosophy of hunting for opportunity exactly when everyone else was at their most extreme.
Right. And, picture this. It is January of 2000. The dot-com bubble is the definition of peak euphoria.
Templeton is 87 years old at this point. He has been retired for years.
Yeah, he sold his famous funds way back in 1992, and he is just living his life in the Bahamas doing charity work.
Right. By all accounts, an 87-year-old retiree watching television as internet stocks go up 1,000% should just be shaking his head, muttering about how the kids have lost their minds and going back to his tea.
But he was a trader to his very core. I mean, from his home in the Bahamas, this 87-year-old picks up the phone, calls his broker, and places an order to short 84 different internet companies.
Wow. 84 companies.
Yeah, and he puts roughly $2.2 million into each position. That is over $180 million betting against the hottest market in history.
Okay, let's unpack this, because shorting the dot-com bubble in early 2000 was usually a death sentence for portfolios. How did he know when to strike?
Well, he didn't use normal metrics.
Right, I imagine you can't just look at traditional valuation. He wasn't looking at price-to-earnings ratios because, well, these companies didn't have earnings.
Exactly. He completely ignored traditional valuation metrics. His logic was based on something much more fundamental, which is structural supply.
Structural supply. Meaning what, exactly?
Meaning he wasn't looking at the buyers, he was looking at the sellers.
I think of it like an incredibly wild, chaotic VIP party. Everyone is trying to get in. The line is around the block. People are paying crazy covers at the door.
That's a great way to look at it.
Yeah. But you happen to know the exact minute the VIPs, the people who actually threw the party, are going to sneak out the back door with all the cash. Templeton wasn't looking at the guests. He was looking at the hosts.
Yes. And to build on that, not only are the hosts sneaking out the back door, but imagine they signed a contract when the party started that said they legally could not leave for exactly 6 months.
The lockup period.
Right. Every single one of the 84 companies Templeton shorted was a recently IPO'd internet stock. And every IPO has a lockup period.
Right. This is a legally binding time frame where the insiders, the founders, the early venture capitalists, they are strictly prohibited from selling their shares
They are literally trapped inside the party.
until the clock runs out. And Templeton knew human nature.
Oh, absolutely. He knew these insiders were looking at their company's absurdly inflated stock prices and realizing they had won the lottery.
Yeah, they knew the valuations were completely detached from reality. So what is going to happen the very second that legal lockup expires?
Millions of new shares flood the market all at once. It's guaranteed selling pressure.
What's fascinating here is, well, the precise mechanics of his execution. He didn't just blindly short these companies and wait.
No, not at all.
Yeah.
He timed his short positions to execute exactly 11 days before each specific stock's lockup period expired.
Which is brilliant. But why 11 days?
Because his research showed that the big institutional players, the smart money on Wall Street, they know about the lockup expiration too.
Right, they aren't stupid.
Exactly. They start front-running the event. They start selling and shorting about 1 to 2 weeks before the insiders are legally allowed to dump their shares.
Oh, wow. So Templeton wanted to ride that exact wave of anticipated structural supply. He wasn't fighting the momentum of the market. He was waiting for the guaranteed avalanche.
Yeah, and the result is history. The Nasdaq topped out on March 10th, 2000, and then completely collapsed.
And Templeton walked away with around $86 million in profit, the fastest profit of his entire decades-long life.
It is a masterclass, really.
Yeah.
When the market makes no sense, don't look at the valuation. Look at the mechanics of the supply.
Yeah.
If the people who built the companies are desperate to sell, you should be too.
So Templeton had a cheat code, a literal calendar.
Right. The lockup dates were public information.
But what if you don't have a mechanical clock? What happens when you correctly spot a bubble, you know everything is garbage, but you shift from the cold mechanics of supply to the messy reality of human psychology?
Oh, man. Then you get the agony of being early.
Yeah.
And there is no better or more painful example of this than Stanley Druckenmiller.
Definitely. And for context for anyone listening, Druckenmiller is finance royalty. He was the core partner at George Soros' quantum fund.
Right. Over a 30-year career, he averaged a 30% annual return. And perhaps most incredibly, he never had a single down year.
Which makes this next part totally baffling. I mean, in March of 1999, Druckenmiller looks at the tech sector. He sees companies up 1,000%.
He knows it is a bubble.
So he shorts 12 tech stocks to the tune of $200 million. And he's just completely right about the fundamentals. Like, almost all of those companies eventually went bankrupt.
But he was right at the wrong time. Over the next 4 weeks, instead of popping, the internet stocks go completely nuclear.
Hold on, I have to push back on this. You were telling me a guy with a flawless 30-year record shorts, obvious garbage companies, is 100% right about their fundamentals, and he still loses $600 million in a month.
Yeah.
The quantum fund drops 18% while the rest of the market is soaring. How is the market staying irrational that long?
Well, that is the danger of fighting pure momentum without a structural catalyst. The market can remain irrational much longer than you can remain solvent.
Right.
And this is where Druckenmiller's psychology starts to fracture. You have a man who has never had a losing year. He is staring at an 18% hole, and he is watching amateur day traders make millions while he bleeds.
Here's where it gets really interesting. Because Druckenmiller's brain is screaming that these stocks are worthless, but his ego cannot handle losing his perfect record.
No, it was tearing him apart.
So he does something that sounds like a joke. He hires two 20-something traders, fresh faces, and tells them their only job is to blindly buy every hot internet stock out there.
It's unbelievable.
Yeah.
He essentially outsourced his capitulation. He knew his rational brain could not bring himself to hit the buy button on garbage companies, so he hired kids who did not know any better to do it for him.
And it somehow worked. I mean, these kids were making 3% returns daily. They dragged the fund out of the hole, and they finished the year up 35%.
So he saves the record.
He saves the record. But fast forward to January 2000, Druckenmiller has a moment of total clarity. He realizes the market is trading at a 104x PE ratio.
Which is completely unsustainable.
Right. So he cashes out and steps off the tracks right before the train crashes.
A brilliant, rational move. Except he doesn't fire the two 20-somethings. They keep trading their smaller accounts.
Oh, no.
And Druckenmiller is sitting there in cash, doing nothing, watching these two kids pull in 50% returns in a matter of weeks.
If you are listening to this on your commute right now, think about that. A billionaire financial genius was broken by the exact same FOMO you feel when your neighbor brags about a crypto coin they bought. Envy scales, no matter how rich you are.
This raises an important question, though. Like, how strong is your rational mind when confronted with the irrational success of others?
Not very strong, usually.
Right. Charlie Munger had a brilliant quote about this. He said, "Envy is the stupidest of the 7 deadly sins. It's pure pain with no yield."
That is so true.
You don't even get the fleeting pleasure of gluttony or lust. You just get the misery of watching someone else get rich.
And that misery broke him. In March 2000, Druckenmiller later admitted he picked up the phone 3 times to buy back into the tech boom.
Yeah, twice he put the phone down.
But the third time, he placed the order. He bought back in heavily, roughly 1 hour before the absolute top of the dot-com bubble.
One single hour, and the market immediately collapses. He lost $3 billion.
$3 billion, wow.
His legendary run at Soros came to an end, all because he couldn't stand the pain of being right, but sitting on the sidelines.
So Druckenmiller showed us that betting against a mania based on pure psychology is suicidal. You can't just short the frenzy without a safety net.
No, it's too dangerous.
But what if you are already holding a portfolio full of highly vulnerable stocks and you literally can't sell them? How do you survive when you hold a terrible hand of cards?
Well, then you have to look at the underlying mechanics of insurance. That brings us to Bill Ackman and the concept of the asymmetric shield.
Right.
It is a masterclass in risk management.
Let's set the stage for this one. February 2020, the market is hitting all-time highs. The S&P is at 3393.
Things are looking great on paper.
But the news is starting to show terrifying footage of a new virus, COVID-19, shutting down cities in China and Italy. Wall Street is ignoring it, though. The market is completely euphoric.
Meanwhile, Bill Ackman, who runs Pershing Square, looks at his portfolio, and it is a disaster waiting to happen.
Because of what he held, right?
Yeah, he owns massive stakes in companies like Hilton Hotels, Lowe's, Starbucks. If the world locks down, these physical, consumer-facing businesses are going to be decimated. He is holding the worst possible cards for a pandemic.
So the logical move would be to sell, right, dump the vulnerable stocks. But he can't.
No, he really couldn't.
He has massive unrealized gains, so selling would trigger a catastrophic tax bill. Furthermore, Ackman is an activist investor. He holds these shares so he can sit on their boards of directors and force strategic changes. If he sells the stock, he loses his power. He is trapped.
Exactly. He can't short the market because of the risks we just discussed with Druckenmiller. He can't sell his positions, and he is staring down the barrel of a global pandemic.
So what does he do?
Instead of panicking, he takes $27 million, which sounds like a lot, but for his fund, it was just 0.3% of his total capital.
Basically pocket change for Pershing Square.
Right. And he uses it to buy something called credit default swaps, or CDS, on corporate bonds.
Wait, I need to pause you there. With home insurance, I can only buy a policy for my house. You're telling me Ackman was legally allowed to buy default insurance on corporate bonds he didn't even own? How does that mechanism actually work?
It goes dumper than traditional insurance. A credit default swap is a financial derivative. You aren't insuring physical property. You are essentially making a side bet with another financial institution about the likelihood of a company failing to pay its debts.
So it's just a bet on a financial outcome.
Exactly. It is perfectly legal in finance to buy protection against an event, even if you don't own the underlying asset. If corporations start defaulting, or if the market simply perceives that the risk of them defaulting has spiked, the value of that swap contract explodes.
So what does this all mean? Imagine you live in a valley, and you can literally smell a massive rainstorm coming over the mountains. You know a flood is imminent. But the local insurance company has their head in the sand. They are still pricing flood insurance as if you were in the middle of a 10-year drought.
And taking that further, you don't just buy a policy for your house, you buy policies covering the whole neighborhood because the premium is practically free.
Oh, wow.
Yeah, when Ackman brought these swaps, the market was so complacent that credit spreads, the perceived risk of corporate defaults, were at historic lows.
This is what you call an asymmetric trade. The math is beautiful. Ackman's maximum loss was strictly capped at his premium, which was $27 million.
Right, the 0.3%.
If he was wrong and COVID vanished, he loses 0.3% of his fund. He'd barely notice. But if he was right, the upside had practically no ceiling.
And we all know what happened in March 2020. The lockdowns hit. The S&P 500 crashed 35% in a matter of weeks. The corporate bond market seized up in sheer terror.
And the value of Ackman's $27 million flood insurance policy skyrocketed to $2.75 billion.
But the execution is what makes it legendary. He didn't just hold it forever. On March 23rd, the exact day the S&P hit its rock-bottom low of 2237, and the very day the Federal Reserve announced unlimited quantitative easing to save the economy, Ackman cashed out his swaps.
Perfectly timed.
Yeah, he walked away with $2.6 billion in pure profit.
And he immediately took that $2.6 billion and poured it right back into the very companies he couldn't sell. Hilton, Lowe's, Starbucks.
Buying massive new stakes at rock-bottom panic prices.
He ended that year up 70%.
Unbelievable.
That is the beauty of asymmetric insurance. You don't have to flee a frenzy. You don't have to sell your great companies if you can find a dirt cheap way to protect your downside.
Exactly, but Ackman used a global pandemic as his catalyst. That is a rare exogenous shock.
Right, you can't always count on a virus. What if you don't have a virus on the horizon? Can you find hidden structural breaks in the financial system itself?
You absolutely can if you look in the right places. The year is 1992, and the arena is the European Exchange Rate Mechanism, or the ERM.
Let's give some context for the listeners. Think of the ERM as the precursor to the euro. It was an agreement where European countries promised to keep their currencies tied to one another within a very tight, fixed band.
Right, they were handcuffed together to create economic stability across borders.
But handcuffs are only stable if everyone is walking in the exact same direction. In 1992, Germany had just reunified, and they were terrified of an inflation spike.
Yeah, they had serious historical trauma with inflation.
Exactly. So to cool their economy, the German central bank started aggressively raising interest rates.
And because of the ERM handcuffs, the UK was dragged along. But the UK was in a completely different boat. They were suffering through a brutal recession.
Right. They desperately needed to cut interest rates to stimulate their economy. But to keep the British pound's value up and stay locked to the German mark, the UK was threatening to raise rates.
It was a macroeconomic trap. All the biggest financial minds in the world, George Soros, Paul Tudor Jones, even our friend Druckenmiller, they could see the tension.
They knew the UK economy was going to crack under the pressure of high interest rates. But no one knew when it would crack or what the exact mathematical breaking point was.
Until a 31-year-old trader at Soros's fund, Scott Bessent, did the homework that everyone else ignored.
This is my favorite part.
Right. While all the macroeconomic heavyweights were staring at currency charts and central bank statements, this kid decided to look at something incredibly mundane: British homeowner mortgages.
Wait, so all the biggest macroeconomic minds were staring at international currencies. But a 31-year-old figured out the entire global puzzle by looking at local homeowner mortgages.
Exactly. What he found was the ultimate catalyst. He discovered that unlike in the United States, where most people lock in a 30-year fixed-rate mortgage, the vast majority of mortgages in the UK at that time were variable rate.
Unpack that for the listener because it changes everything. A variable rate means the central bank's interest rate is basically a direct dial connected to the checking account of every citizen in the country.
Yeah, it's instant impact.
If they turn the dial up, millions of families instantly bounce their grocery checks the next week. It would completely wipe out the consumer. The housing market would instantly collapse, unemployment would skyrocket, and the sitting government would be voted out immediately.
Precisely. Bessent calculated that if the UK central bank actually followed through on their threat and hiked interest rates by just 1% to defend the pound, the monthly mortgage payments for everyday British families would instantly jump by 8 to 12%.
Ouch. That is massive.
Yeah. So Bessent proved mathematically that the UK central bank was bluffing. They simply could not raise rates for any sustained period without destroying their own country.
So he took this math to his boss, George Soros, and Soros looked at the rock-solid, undeniable logic and delivered one of the most famous quotes in Wall Street history. He said, "If the logic is this good, why not go all in? Short $10 billion.
If we connect this to the bigger picture, shorting $10 billion of a currency isn't just a bet. It is a physical attack on a central bank's reserves.
Right.
When Soros shorted the pound, he was essentially borrowing billions of pounds and selling them immediately, forcing the UK central bank to constantly buy them up to maintain the currency's value.
And on September 16th, 1992, a day now known as Black Wednesday, the UK central bank tried one last bluff. In a single day, they hiked interest rates from 10% to 12% to an agonizing 15%.
Just desperately trying to defend the pound and scare off the short sellers.
But Soros and Bessent, armed with the absolute certainty of their mortgage math, they did not blink. They just kept shorting.
They knew the UK couldn't sustain 15% interest rates for even a week without defaulting millions of homeowners.
By that evening, the bluff was called. The UK capitulated. They exhausted their foreign reserves, dropped their rates back down, and humiliatingly withdrew the pound from the ERM.
And the currency collapsed, and Soros and Bessent walked away with clean $1 billion in profit.
Incredible. Making money in a crazy market isn't about guessing the direction of a currency or a stock. It is about finding the exact structural truth hiding beneath the political noise.
Yeah, that's exactly it.
So, bringing this all back to you listening today, we look at the market right now, stocks surging, semiconductors flying, optimism everywhere. Are we in a frenzy? Perhaps.
Things might be overheated for sure.
Yeah, but we aren't quite seeing the pure 2000-level IPO madness where companies with no business models are going public every single day.
Yet the lessons from these titans remain perfectly applicable to whatever market you find yourself in.
Absolutely. First, look for structural truths, like Templeton tracking lockup contract expirations or Bessent crunching the math on variable rate mortgages. The truth is always in the structure, not the sentiment.
Right. And second, look for asymmetric insurance. As Ackman showed, you don't have to sell your winners if you can find incredibly cheap protection that pays off massively if things go wrong.
And above all else, never let FOMO dictate your actions. Druckenmiller was a genius, but envy and the pain of missing out cost him $3 billion in his reputation.
Yeah, you have to stay rational when the world is irrational.
So, we leave you with a final provocative question to mull over today. Look at your own life, your career, or your portfolio. If you had to find one asymmetric bet today, a move with almost zero downside but massive potential upside if things suddenly go crazy, what would that look like for you?
That's a great question to think about. Find your flood insurance while the sun is still shining.
Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for information and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you like to access wider topics including life and investing philosophy, please subscribe to our sister channel Deep Values. Don't forget to like this video. Much appreciated.